Imagine waking up one morning to find banks frozen, market halted, and governments announcing emergency measures before breakfast. If you think that sounds like 2008, here's the shocker. What's coming next could make 2008 look like a warning shot, not the main event. Most people remember 2008 as the ultimate financial disaster. Lehman collapsed, credit vanished overnight, and trust in the system shattered. But what almost nobody talks about is this. The world never actually fixed the problem. It covered it up, it delayed it, and it quietly made it bigger. That's why 2026 is being whispered about in boardrooms, central banks, and hedge funds as a year that could redefine how money, power, and stability really work. Back in 2008, the crisis came from leverage stacked on leverage, tied to housing, wrapped in complex financial products that almost no one understood. The response was simple and extreme. Print money, slash interest rates, bail out the system. At the time, it felt necessary, and maybe it was. But that emergency response became permanent policy. Interest rates stopped being a temporary fix and turned into a way of life. Trillions became the new normal. Debt stopped being scary and started being encouraged. Fast forward to today and look at the scale. Governments are drowning in debt. Corporations are addicted to cheap money. Consumers are stretched thinner than ever. And central banks are trapped. They can't raise rates too high without breaking something. They can't cut rates too much without destroying their currencies. That's not stability. That's a standoff. Now here's where 2026 starts to look different from 2008. In 2008, the crisis was largely financial. Banks, mortgages, credit markets. Today, the stress is everywhere at once. Sovereign debt, commercial real estate, shadow banking, derivatives, pensions, currency systems. Even geopolitics and energy markets are tied directly into financial stability. It's one giant interconnected web. Pull one thread, and the tension moves instantly across the entire system. Think about commercial real estate, office buildings empty, refinancing walls approaching. Loans written at near nil rates now rolling over at much higher costs. In 2008, housing was the crack in the foundation. In the next reset, it may be entire cities' balance sheets. Then add government bonds, the so-called safest assets in the world. For decades, they were treated like cash with interest. Now they're volatile. Central banks themselves are sitting on massive unrealized losses. That was unthinkable in 2008. And then there's the psychological shift. In 2008, people still believed the system could be fixed, that trust mattered. Today, trust is thin. People question inflation numbers. They question bank safety. They question whether their savings actually mean security. Once confidence goes, liquidity follows. And once liquidity goes, things break fast. This is why many analysts believe the next crisis won't look like a sudden crash. It will feel more like a controlled demolition. Rolling stress, quiet interventions, emergency rules introduced on weekends, limits that start as temporary and somehow never leave. Not chaos in the streets on day one, but a slow realization that the rules of money are changing in real time. 2026 hits right in the danger zone. Massive debt rollovers, political pressure on central banks, aging populations drawing down savings, and a financial system far more leveraged and complex than it was in 2008. The ingredients are already on the table. The only question left is timing and trigger, because history shows that crises never arrive when the system is ready. They arrive when confidence is highest and safeguards feel unnecessary. And right now, despite all the noise, most people still believe central banks are in control. That belief may be the most dangerous asset of all. In 2008, the trigger was obvious once it happened. Subprime defaults spiked, mortgage bonds imploded, and leverage snapped. In the next reset, the trigger may look almost boring at first. A failed bond auction, a large institution quietly asking for liquidity support, a currency moving too fast over a single weekend. Individually, none of these sound catastrophic. Together, they can set off a chain reaction that no one can stop without rewriting the rules. What makes this cycle especially fragile is the lack of room to maneuver. In 2008, interest rates could be slashed aggressively. Balance sheets could be expanded without immediate backlash. Today, inflation changed the equation. Print too much, and purchasing power collapses. Tighten too hard, and debt implodes. Central banks are boxed in by their own past success. Every tool they used to save the system last time now carries heavier side effects. Look at global debt levels. They are not just higher than 2008. They are exponentially higher. Governments rolled corporate risk onto public balance sheets. Central banks absorbed losses that were never meant to be permanent. This created a strange illusion of safety. Risk didn't disappear. It just moved. And when risk concentrates at the sovereign level, the reset stops being a banking problem and becomes a currency problem. Currencies are trust instruments. They only work because people believe tomorrow will look similar to today. But what happens when fiscal promises stretch decades into the future with no realistic path to repayment? What happens when populations age faster than productivity grows? What happens when geopolitics fractures global trade and raises costs permanently? These are not temporary shocks, they are structural shifts. And markets eventually price structure. Another key difference from 2008 is speed. Back then, information moved slower. Social media wasn't a real force. Banking apps didn't exist in your pocket. Today, capital can flee instantly. A rumor can cause billions to move before regulators even issue a statement. That speed turns all cracks into full fractures almost overnight. Confidence doesn't erode gradually anymore. It vanishes. Then there's the quiet expansion of the shadow system. Private credit, off-balance sheet vehicles, complex derivatives sitting outside traditional regulation. This is where leverage hides. In 2008, much of the damage came from areas regulators thought they understood. Today, a significant portion of risk lies in places most people have never heard of. When stress hits there, transparency disappears just when it's needed most. This is why many insiders believe the next reset will involve more than bailouts. It will involve restructuring, new settlement systems, new rules for access to money, possibly even limits on capital movement framed as stability measures, not because of conspiracy, but because math forces those decisions. When liabilities outgrow the system's ability to service them, something has to give. The uncomfortable truth is this: 2008 was a crisis of excess. The next one may be a crisis of credibility. Once people stop believing that promises can be kept, the entire financial architecture has to adapt. That adaptation is rarely smooth, rarely fair, and never evenly distributed, which is why the real impact won't be measured only in markets, but in everyday life as households start to feel the pressure of a system straining under its own weight and asking itself a question it had avoided for years, namely, whether the future can still be financed the way the past was. That single question sits at the heart of why 2026 matters so much more than another market cycle or another recession headline. At some point, the numbers stop being theoretical. Interest costs consume tax revenues. Pensions depend on returns that no longer exist. Banks hold assets priced for a world that disappeared years ago. When that realization hits collectively, policymakers don't panic publicly. They reframe. They change definitions. They introduce new mechanisms and call them modernization, resilience, or reform. But underneath the language, it's a reset. A true financial reset doesn't announce itself with sirens. It happens through policy decisions that permanently alter incentives. Cash becomes less attractive. Risk-free assets aren't risk-free anymore. Long-term saving feels punished while short-term survival is rewarded. People sense something is wrong long before they can explain it. This is where 2026 could eclipse 2008 in impact. Not because markets fall further, but because the social contract around money shifts. In 2008, the goal was to restore the old system. In the next reset, the goal may be to transition into something new, whether populations are ready or not. Digital settlement systems, tighter financial surveillance, more direct links between state policy and personal balance sheets. These aren't futuristic theories. They're logical responses to a system under extreme stress. And here's the part that rarely gets discussed. Resets create win. Winners and losers long before headlines admit a crisis exists. Those closest to liquidity adapt first. Those relying on fixed incomes or delayed promises adapt last. Inflation, currency shifts, and policy changes don't hit evenly. They hit quietly, then suddenly, then all at once. For individuals, this doesn't mean panic, it means awareness. Understanding that stability is not a guarantee, that diversification is not just about assets, but about flexibility, skills, mobility, optionality. In 2008, many people were blindsided. In the next reset, the information is already out there. The signals are flashing. The only difference is whether people choose to see them. Every major financial transformation in history followed the same pattern. Excess builds. Confidence peaks, stress fractures appear, then the rules change. Not overnight, but permanently. The year attached to it becomes a reference point. 1929, 1971, 2008. 2026 may be next on that list. The uncomfortable reality is that systems don't fail because of bad intentions. They fail because of arithmetic. Promises compound faster than productivity. Debt grows faster than income. And eventually the math wins. When it does, the reset isn't a choice. It's a necessity. If 2008 taught the world that leverage can break markets, the coming reset may teach a deeper lesson, that trust is the most fragile asset of all. 2026 isn't about predicting a single crash date or dramatic headline. It's about recognizing a convergence of pressure that no central bank can indefinitely contain. The next global financial reset will likely be quieter, broader, and more personal than anything we've seen before. Those who understand the forces at play won't be immune, but they won't be confused. And in a world where the rules of money are being rewritten, clarity may be the most valuable currency left.